right. Good morning, guys. How's everybody doing?
Good morning.
Hello, Jeff.
Great.
Monday
Hello,
morning.
Roger. Hello, Owen.
So,
Morning.
as the show is called Unscripted, so no prep. But I will tell you guys, I was really excited to do this. I think I won't speak for Roger, but when people ask me what my favorite part of my job is, it's it's just getting to be a part of the journey with entrepreneurs and living through all the hard times. And then when there's those moments of goodness, you want to kind of talk about it. And so this just with the financing you guys announced yesterday, thought it'd be a great time to come on, bring a legendary venture capitalist on with us. That's Roger, not me. And just chat a little bit about the journey. So maybe you guys could start, Ollie and O, maybe you guys could start a little bit just talking about the history of Belong, when you started it, why you started it, and then I'll jump in and ask a few more questions. But start with that. Give us a little bit of the history and your personal history, because I think your backgrounds with your prior experience are so helpful for people to hear, other entrepreneurs, other founders that are, trying to learn about how to build a business.
I was hoping you were going to say that your favorite part was working with us.
That is it.
Ale and I laugh because we like saying that we have very similar backgrounds. I think that our mothers fight on who started coding first, and the ages keep getting lower. We started at 7, we're at 4 now. But we're both coders since we were very young. Built companies, I think, as teenagers and young adults. And we actually met here in the States after Ale graduated from MIT and I graduated from Stanford. Ale had this crazy idea of selling cars online, sight unseen, with no test drive, something that was obviously never going to work. And somehow I believed him. And so we started working together on a company called BP, which was quite a ride, grew very quickly, managed to do the unthinkable and sell cars online. We did a lot of good things. We made a few critical mistakes and learned a lot from the process. And after we ended our ride with BP, we took some time to decompress and think about what's next.
And just for reference, what years were that? What years did you start it?
This was from 2013 to the end of 2016. It feels like a lifetime.
I know.
It was 3 years, all in all. We took some time to decompress, think about our learnings, think about what we wanted to do next. And we asked ourselves several questions. One was, do we want to do this again? This being start a new company, go back into the fight of starting to create something from nothing? And I think the answer was an obvious yes to both of us. This is something that we love doing, creating something where nothing existed before. The second question was, okay, do we want to do this together or do we want to go our separate ways? And again, the answer was yes, we wanted to do it together. First, we enjoy working with each other, but also I think that we complement each other. We share the things that are important, values, ethics, how we see the world, and optimism on how to build things. And we're different enough in ways that matter also. Our communication style, how we prioritize various things, how we think about building. We like saying that if we both agreed about everything all the time, then one of us would be redundant. And that's not the case, as there are many yellings in our office from time to time can attest to. And then the third natural question was, okay, what is it that we're going to build? And the guiding principle for us here was the notion of authenticity. We wanted to build something that was not only interesting to us, but that we could bring some added value, some added benefit to as well. So there were many things that were interesting to us. And in fintech, for example, when we went down the crypto rabbit hole, as everyone did back in 2017, and started thinking about banks and financial services and other things like that, which I think are fascinating, but neither of us comes from a financial background. And it felt like that was not it, that we were trying to force ourselves on a problem rather than solve something that was authentic to us. And as we were reflecting about our shared experiences, our past experiences, the rental transaction was the first thing that came to mind. Alice shared how when he was moving from one home to the next, his previous landlord lied in the reference check saying that he wasn't paying rent on time because she didn't want him to get the new home that he was applying to. Tyler, our third co-founder, shared how when he was moving, his landlord said that he wasn't going to return the security deposit. And if they insisted, he was going to complain to the bar where Tyler's girlfriend was just admitted as a new lawyer and obviously didn't want to start her career off with a complaint. And in my case, I had a landlord who physically broke down the door to the home, kicked it in while I was in the shower because he thought that he heard a dog inside and he didn't like the noise. On the other hand, I, as a landlord back in Israel, had a tenant who was a good tenant who one day became a hermit, stopped paying rent, didn't leave the apartment for 3 months. And by the time that we could evict him, which is quite a lengthy process in Israel, the place looked like a meth den. And so we said, something is obviously broken. Cool story, bro, but what do we do about all of this? And that's how the idea for Belong started coming. The notion of a landlord, the lord of the land, who can wield all the power and use and abuse his poor tenant on the one hand, the power asymmetry between a landlord and a tenant. But when you start digging in deeper, you find that the landlord, and especially the ones that we're going after, and we can discuss it more, are also very stressed about this transaction. They own a very expensive asset, the home. They also have a very strong emotional connection to that home, having either grown up there, their kids grew up there, their parents used to live there. And suddenly you have strangers living in the home with no control. And it causes a lot of stress. And that is a source for a very strained relationship that we're here to solve. And
what year did you guys decide to start Belong, just for folks' reference?
We started it while sitting with our good friends at Andreessen Horowitz, who took us in as entrepreneurs in residence and helped us think about the next adventure. That was in mid-2018. We launched and got our first homes and homeowners in early 2019. So this is the beginning of the third year for Belong.
And another important thing, and that's a wonderful story, that makes me go down the memory line. This is, Owen and I are both immigrants, right? And Cantor's family that, we're immigrants to Israel, immigrants to Argentina. My mother, for example, immigrated 2 times, first to Argentina, then with the parents, then to the United States, then went back to Argentina. Then I came to the United States, right? So I think the profound revelation that we had as we were thinking about the rental transaction is that there's an inherent feeling of failure when you're paying rent. Maybe not when you're 22, right? Life is all ahead of you, and it's normal or expected for you to be paying rent at that time. But what's interesting is that millennials, Generation Z, and the younger Generation X are going to rent for 7 years more than the price in average. Actually, we don't know exactly. It could be more, right? Because it's not yet done. So every time that you pay rent, when you are 32, 33, and by the way, O and I are still renters. So we feel every single ounce of pain. You feel like a failure. And why do you feel like a failure? You feel like a failure, unlike when you go to a hotel or you go to an Airbnb, in which you feel like you're exploring and you are getting service and getting attention, right? In a rental transaction at home, you don't get any of that. You pay thousands of dollars a month, right? And you still are treated like a second-class citizen. And what's interesting is on the side of the homeowners, O was saying, it's not that they homeowners or landlords want to treat tenants or residents badly. It's just that there's a lot of stress. So what we're focusing on is in really finding this idea with the home, the love for the home at the center, right? Both the homeowner and the resident, the tenant, love the home, right? Because that's when they come together. And what's pretty interesting is that there is a way to align economics incentives as well instead of making a zero sum. So it's
And
there's a lot to unpack.
I want to come back to the culture you guys have built, but I think what's so cool about the story is there's millions, well, tens of millions of people that have rented homes or owned homes as rentals and not ever sat down and thought, how could I reinvent this industry? And what I love about it is you guys sat down and said, you know what, we want to reinvent this industry. And that's how so many great entrepreneur stories happen. And then by way of background, so I met you, well, we met you in the BP days. And then you came in and talked to Glenn and I about the crypto stuff you guys were working on. And then I remember you came back to us with the idea for Belong. And we had been lucky to be investors in Open Door and Airbnb. And, I remember you guys left the meeting and Glenn and I were like, okay, this is a big idea, really freaking hard to pull off. Like, this is a massive industry with a lot of people that don't want it to change. But, this team has the potential to do it. And so we obviously ended up leading the Series A, and it's been a lot of fun ever since. So I want to jump over to Roger. Roger, you jumped in and led the Series B. Tell us what got you excited about Belong.
Well, first of all, Jeff, thanks for having me here. I'm excited to be here. I'd say it was a couple of things. One, not surprisingly, is the team. Ali and Owen are uniquely compelling entrepreneurs. A lot of times, or all the time, we look at investments, we think a lot about, founder market fit and the connection that the founders have to the problem that they're solving. And this was one where the fit was hand in glove. And it was clear that if somebody was going to take on this really gnarly, hairy problem, you had to have a very specific set of skills and attributes to do it. And Ali and Owen had those in spades. And so you just heard kind of the journey that they've both gone through and the experience that they had. And so they're uniquely qualified to go after this problem. I'd say that at kind of the EQ level that they both have, there's a level of humility, curiosity, empathy that we have found are really, really important kind of early proxies of long-term success. And this is not going to be solved in 1 year or 2 years. This is a 10, 20-year journey. And so when you're wired that way, it gives you a much higher likelihood of success. And I think the team is kind of, again, uniquely has those attributes. The fact that, despite going through the BP journey together, the vast majority of the team is still working together, many, many years later, is an indication of what great leaders they are. And so that to us was kind of first and foremost, the headline of why we got so excited. I'd say secondly, in terms of the actual opportunity and the market, I actually went through this experience directly. So I experienced the pain of the accidental homeowner, as Ali and Owen like to talk about it, where, we sold a home a few years ago. We were moving nearby. And we thought actively, my wife and I did, about actually renting it out and turning it into a rental property. And we spent probably 6 months interviewing property managers, going down kind of that whole journey, and came out of it incredibly disappointed and really shocked at just how archaic the state of the industry was. All the things we take for granted, in terms of e-commerce, entertainment, all these industries that have been digitized, this industry was still literally like, it hasn't changed in 50 or 100 years. And so ultimately we just gave up and we ended up just selling the house. And we really didn't want to. We really wanted to continue owning. We really wanted to rent it out. But the property management solutions that were available just didn't come close to meeting our needs. In retrospect, that was a really bad decision economically because, real estate prices in the Bay Area have done very well the last few years. So we ended up losing money and it was the wrong thing to do, but we felt like we didn't have a choice. Mm-hmm. It turns out that's not a unique experience. There are 23 million people that are in the same situation we are, that are accidental homeowners that, have relocated for a job, maybe inherited a home from their parents or grandparents. And are not equipped to kind of institutionally run a real estate business, but they want to own this second home and want to have it managed for them. And there is this incredibly fragmented ecosystem of property managers, hundreds of thousands of them with no brand, no technology, no innovation whatsoever, raking in literally hundreds of billions of fees every year with an average NPS of 0. Yeah. And so when we looked at that, we said, we have this amazing team that is absolutely purpose-built to go solve this problem. and you have this huge market generating hundreds of billions of revenue with an NPS of 0. Something has to break. And when you apply just an amazing team to a big market like that, and really just unbounded runway to just reinvent the experience for both the homeowner and the renter, that usually yields a really exciting outcome. So that's what got us excited. And hats off to you and Jeff Jordan for seeing this one early and getting involved early, because we're honored to be part of the team and to help out any way we can.
And Roger, as you guys, what maybe for folks that are tuning in that are either founders looking to raise capital or other investors, but particular founders, as you turned around and were trying to tell this story to your partners internally, what were the questions that came up? Because, I can tell you what came up on our side, but we had the benefit of having been in Open Door in particular, which was a really hard business to build. And I kept telling our team, hey guys, this is going to be a hard business to build, but this is the right team to do it, right? And oftentimes, if you get the right team with a hard business, that's how you get to big outcomes. What questions came up for you? I always tell founders, think about the partner you pitched, turning around and pitching, her or his partners. What questions came up for you as you were telling the Belong story internally?
I think a lot of it, it goes back to kind of the thematic work we had done probably, over a year ago, where we have a very concerted focus of backing kind of these full stack solutions. And the only way you're going to tackle the most interesting, largest TAMs on the planet are really kind of rethinking the customer experience from top to bottom. And when you take just a small slice of the problem, in theory, it looks like a more efficient, more elegant business, and it might be in the short run, but it's ultimately much more prone to disintermediation, and the moat, the depth of the moat is much narrower. And so we kind of made this very conscious decision just at a thematic level that all the consumer investing we were going to do going forward was going to be going after these very, very big TAMs that really had not been rewired or rethought through. And that was going to require a full stack approach. And once you kind of shift to that mindset, the complexity of an Open Door, the complexity of a Belong, the complexity of an Airbnb become actually very manageable, because you understand that the pot of gold at the end of the rainbow is worth tens, if not hundreds of billions of dollars. And if you win, it has very, very deep network effects. It has really interesting compounding moats. And the chance that there's kind of a winner take most, winner take all outcome that justifies all the work and all the effort to go there. And so we kind of solved, that kind of we have thematic alignment early on. All that said, when we talked about the deal, a lot of the questions comes down to complexity, operational complexity. You're taking over somebody's home. How do you develop that trust? Where does that come from? How do you take on the day in, day out operational maintenance? What are the long-term kind of margin implications of that? How do you think about equity value, as a function of that margin profile? And those are the questions, the kind of the tactical questions you work through. But again, when you're oriented around kind of this full stack solution, you can see through that, because you realize, this thing can compound, almost indefinitely, for the next 20 years and still only have 2% market share or like 4% market share and be worth tens of billions of dollars. So when you have that big of a TAM, you have the opportunity to take on a lot more risk and a lot more operational complexity, just because the outcome is that much more compelling.
I love the way you describe that. Okay, Alano, back to you guys. So one of the things that I have absolutely loved since the day we invested is your monthly updates. You guys send this incredible email. In fact, I think I might have even shared it with Roger when we first connected on this opportunity, with your permission. But you guys are just relentlessly detail oriented about tracking the progress of the business. You were tracking it against the Series A plan that you gave us. And what I think was super fun and is super fun, if I go back and look at those emails, is they just kept getting better, right? What caused you guys to think like that, to want to provide JJ and I with the monthly detail compared against the Series A plan, and go into, because to me, one of the benefits was you were also building the narrative with us as investors and board members about the kind of company you wanted to build. And I think it's incredibly powerful. And I always encourage founders to do that. Don't just, not just the board meeting, but all those different touch points you have with investors and board members over time. It helps you to, create that narrative. Where did you guys learn that, and how does it reflect the kind of culture you're building inside the company?
So that's a good one. There are two things that go into, writing a blog post or sending investor updates or putting together a deck, right? And I see a lot of entrepreneurs, because I made the mistake myself. I'm saying, all those things don't matter. You need to focus on execution, right? Don't pay attention to investors updates. Don't pay attention to blog posts. Don't pay attention to your deck. If your numbers are good, you're going to get funding. You're going to get teams excited. It's going to be good. That's a cardinal mistake. And it's a cardinal mistake for a number of reasons. The number one reason is that a well put, carefully thought investor update forces you, as CEO, as president, as founding team member of a company, to think clearly, right? What are the things that you're going to track? What are you going to track those things against? And most importantly, allows you to share, because as you know, Jeff, we have a pretty detailed challenges section in there, which, by the way, it's not that we expect anything to be done about it, just to share what is it that's going wrong. Because for all entrepreneurs that are seeing this, building company is very, very difficult, right?
Mm-hmm.
So a lot of things happen. I think the most important part, number one, reason why we do it is so that we can get clarity of thought and understand what we're tracking against. The second, and I think that's the other part of it, is none of this is possible if you don't trust who you're working with, right? If you don't trust your co-founders, right? If you don't trust your team members, if you don't trust your investors, right, early, this is a very difficult endeavor, right? Because you are hesitant of sharing challenges. How is Jeff going to think about the challenges? How is Roger going to think about the challenges? You're hesitant of, there's a number that doesn't track to plan. Do I share it or don't share it? All of that starts to work on your mind. So for that, the framework that we used is, and it's also, I think, a consequence of the experience that we had in our previous company, is that, we're going to do our absolute best to work with the greatest people, right? And we're going to trust them. So in a way, it sounds weird, but we're going to think as if we were hiring our investors, not selling a part of our company, right? We're hiring our mentors, hiring the people that been in the road before us, right? They are seasoned investors, and we're going to trust them as if they were an extension of our team. Mm-hmm. And I think by doing those two together, the clarity of thought and the trust, because we also share internally that investor update with our team members. I think that's the reason why we do it.
Yeah, it's awesome. It's a great best practice that at some point I'd love to, maybe we can do some kind of session where you can share that mindset and what you write and how you write it. Because it's also not, I don't know about your take, Roger, it doesn't come across as a form letter. It comes across as very much a stream of consciousness. Here are the key metrics we're tracking, and here's how they're doing versus the plan. Here are the things we're thinking about as a management team. Here are some of the challenges we're running into. And it, when you get it every month, it really, and then you and I will talk over text or on the phone or whatever. But I have a really good sense of how you're thinking about things and what the things are that you're worried about and the things that are going well. Because like you said, I think part of the open kimono exercise here is we all know it's really freaking hard to build a company. I know that, Roger knows that, JJ knows that. And so when you have that level of trust and you just say, hey, it's hard, here are the challenges we're running into, I think it just makes everybody feel more like they're all in the boat rowing in the same direction.
Yeah, and we were lucky enough to be able to choose our investors. Not everyone gets to do it. I think we were very fortunate in doing so. And the partners that we chose for the road, because Roger correctly pointed out, this is a 10, 20-year journey, and getting a divorce is close to impossible. So you need to be very careful in who you bring to the table. And the people who we chose, the two of you and JJ, are operators. They not only understand philosophically the notion of building a company or by reading about it, you've done it. With that in mind, what we want to do is share as much as possible. Otherwise, we get to meet maybe once a quarter in a board meeting. Nobody knows what's going on. Maybe you have what's called the oh shit board meeting every now and then, and nobody understands how we even got there. And that's missing the point. The point is to have you as involved as possible, have all of our partners and investors as involved as possible, intimately understanding what's going on with the business so that you can provide valuable feedback and insights in real time. And that's a notion of transparency that we share both inside the team and outside of it.
And lastly, that's a very important point. And lastly, I would say one thing that we try to do is, as we do when we operate Belong as well, and we build Belong as well, is incorporate the human element, right? Mm-hmm. We as management team, as founders, the team that work alongside us, we're all human. So are the homeowners, so are the residents, so are the pros and service providers that serve the homes, right? So I think Elon Musk said, well, he said many good things, but he said one of the things that he said is too many MBAs in boards, right? I think that Owen and I had an MBA, incredibly, so it's pretty funny. But it's, I think the concept, you get together as a board, you get together as management team, and you perpetually discussing metrics that are extraordinarily important, right? But you can't just focus on building a business based on metrics, right? Because the business is built by humans for humans, for now, until the robots take over. Sharing that in the investor update, sharing that in everything we do, in every communication, highlighting the human aspect of everything we do, and why we do it, and for whom we do it. Mm-hmm. That is a very important part of our philosophy.
Can you guys talk a little bit about fundraising? So I think when people see an announcement like the one you came out with yesterday, you know, we raised a seed from Andreessen, an A from GGV, a B from Battery, and they think, oh, this must have just been slam dunk, smooth sailing. These guys must have had it in the bag from day one. Can you talk a little bit about what the fundraising process has been like for you at Belong? Because we also went through, by the way, a global pandemic last year where every single founder, I mean, how many times did we chat and we said, hey, you know, what are we going to do? How are we going to power through this? What's our business look like on the other side? When's the right time to fundraise? I think just opening up a little bit about, you know, even for a company that's been as successful as you guys are and repeat founders, that it's not been easy to raise capital and manage the company along the way. So whatever you're willing to share. And then Roger, I'd love to just get your take on, you know, given the market we're in, the hot market, you know, what advice are you giving to founders that are going through these cycles as well? But let me start with all I know. Talk a little about fundraising over the last 6 to 9 months, guys.
All right. So first of all, fundraising is always extraordinarily tough. It's a brutal process. It's interesting, as you correctly just said. You announce the round, you announce the C, the A, the B, the C, the 100 millions, the billions. Like you look every day, you open PitchBook or open the newsletters from the financial journalists that do an amazing job reporting the news. And it looks like, why are there so many companies doing this? It must be that they know something. This founders, this CEOs know something that I don't know, right? And that's it's a narrative mirage, I think. Mm-hmm. Fundraising is one of the most brutal, most difficult things a founder can do. The reason why you see, or why we see 7 companies raising in the first 2 hours is because there's a lot of supply of companies, right? There are thousands of companies that are going every day to fundraise, and 7 get funding. So it's amazing for the economy as a whole. It's amazing for innovation and our culture of building new stuff for the world that adds value, right? It's awesome that there are 1,000 new companies each day that go to fundraise. 7 get a term sheet, right? But at the same time, there are 993 founders. If it's a sole founder, maybe thousands of founders that don't get a term sheet, right? So it's an extraordinary brutal process. So the most important, I think, that I say is that you get better over time, right? I think that O and I have raised funds. The Series B was our 7th formal fundraising process in Silicon Valley. And over time, you get to understand some of the dynamics, what it's that matters, right? What kind of investor you're seeking. Right? One of the big things that I see entrepreneurs making mistake with is they're just pitching a fund. But a fund, again, it's a carcass, right? It's not, a fund is composed of general partners and junior partners and vice presidents and associates. All of them are humans, right? And it's not the same to work with one partner at one firm, with another partner at another firm. It's not the same to start the relationship with a partner, with an associate. It's all those human dynamics are extraordinarily important, right? Overall, the way that O and I did it this time is we said, we think we want to raise in the beginning of January. Here is the 25 things that we need in the data room by this date. We made all our team part of the process. That's another thing that I made a mistake in the past, and I see a lot of founders doing, which is they isolate their team from the fundraising process. So it's just the CEO's responsibility or the founder's responsibility to fundraise, right? When in reality, it's much better to involve the entire team very early, right? Even 2 quarters, 3 quarters before you're planning to fundraise, you need to say, hey, I want to go and fundraise in Q1. Here's where we need to be, and here's all the data that I'm going to need in order to fundraise. How can we make it better, right? How can we make it look amazing, right? Make them all part of the process when we are pitching funds, when we are talking with new partners. All of them, if they are the right team members, have something to say, some counsel to give you, some way to stay part of the story in a different way, right? Also, the added benefit is that when you end up being successful in fundraising, all the team members feel that this is their win as well, right? Overall, this time around, we structured extraordinarily strictly, I'd say. I think we had around 30 meetings, first speeches with funds in the first 2 weeks of January. And really, we ended up having 6 or 7 partners meetings in the end. So it was a pretty healthy funnel. But one of the reasons was that we already had everything in the data room ready, completely structured. And look and say how much work he personally put into that as well. Because we had a memo for finance, a memo for marketing, a memo for a strategy, a memo, like every single aspect of the business, how we think about the future was available when I took the first meeting with each of the investors. And that naturally, I think, helped clarify the thinking of the story. And Roger, you tell me how you felt it on the other side, right? But it's I feel like what it conveys is that there is a clear picture of what's happening.
I would also add before you jump in, Roger, you guys were very intentional about who you were talking to. So we had multiple conversations where you went through the list of folks that you were meeting with, and we sort of prioritized and thought about their backgrounds and thought about their points of view. And, to your point, Ollie, it was very focused on the person and less on the firm and what you thought that person could bring to the table. And I thought that was a really great way to do that. It just shows the way you guys are very intentional about how you think about who you're going to have around the table. Because it was less about, yes, you met with quite a few folks, but you quickly narrowed it down and were like, hey, this person feels like they really understand what we're trying to accomplish. They're bought into the market. They've funded other things that are relevant. So I was super impressed with the way you did that. And, I would say from my side, it was no accident that we ended up with an investor that I think was a great fit. But Roger, maybe you can talk from your end.
Well, thanks. That's nice to say. I was worried Ali kept using the word brutal. And it was a brutal process. And so hopefully it wasn't that painful and that we weren't that difficult to work with. But maybe we were, but hopefully not. Look, I think Ali summarized it well. And actually, Ali said something to me during the process and us getting to know one another I thought was very wise. And I've mentioned it a few times since, which is you don't raise this round just for this round. You're raising it to prepare for the next round. And what I heard from that, the story I made up was that, and it dovetails with advice I've given to other founders, which is, yes, you are financing to get a Series A or a Series B done, but as soon as that round's done, you're already preparing for the next round. And typically what a lot of the founders I work with will do is they will kind of take the some of the investors that are not part of that round, start working with them closely and prepare them for the next round. And so they actually they don't receive the monthly letters that we just talked about, but they'll get a quarterly update, and they will very deliberately stay in touch and communicate to 3 or 4 investors over the next 12 months, what's going on, what's working, what's not working. And so you're already kind of nurturing this relationship in preparation for the next financing. And if you do that well, you might get 1 or 2 that want to preempt and want to lean in aggressively because you've built up the relationship, you've built up credibility, you've built up trust. Worst case scenario, by the time you decide to do a more deliberate fundraise, you've already got some people, that are well prepared and can move quickly. And so if there is one tactical suggestion, I would encourage, founders to think about doing that. And so don't kind of end the process as soon as the money is wired, but in fact, start nurturing the next set of relationships, because you've already spent a lot of time, probably the past 3 or 4 months, developing some sort of connection with these investors. There hopefully are at least 2 or 3 you feel pretty good about. Continue to nurture those, continue to stay in touch with them, give them quarterly updates. And you'll be surprised, I think, how many of them will want to lean in and invest, even if it's at 2x or 3x the price, a year, 18 months later. And it's a way, I think, of minimizing how burdensome and brutal the process is that Ali mentioned before. The other thing it allows you to do is be really deliberate about the people you bring on board. I think both Ali and Owen have said this a couple of times, that they wanted to select their investors, that they wanted to do diligence on their investors. And this is an opportunity for the founder to do a lot of reverse diligence on who they're going to invite to the party for the next round. And so, building on what Owen said before, it's easier to get divorced than it is to get rid of your investors. And so founders should be doing just as much background and diligence checking on their investors as the investors are doing on them. And so this gives you a really nice time frame to do that, so that when you do make that commitment and bring them on board, you know exactly what you're getting into.
Couldn't agree more. You guys are probably similar to us. We have so many companies that we funded at the Series B or C or D that we had met in a prior round and stayed in touch with, and they got to know us, we got to know them. And I never understand the narrative in the market of like, don't spend time with investors, just, run the ambush financing. I never understand that. It just seems like a weird way to put the right people around the table. So kudos to Ali. I know you guys are great at that. Hey, let me
just say that.
Oh, go ahead.
Just to tie into the, choosing the right investors and having the right people around the table also helps with fundraising. The obvious one is, the brand name of the firm and the brand name of the partner that can bring additional investors. But it's much more than that. Ali mentioned that we did 7 rounds of financing in Silicon Valley. We feel like seasoned veterans. But you guys, between the 3 of you, probably close from pitch to funding 7 a month. And so it helps when, as we are going to fundraising, it helps when your current partners and investors can give you the market overview of what your company could look like to potential investors. What do you need to work on? Are there things that you need to improve a couple of months before you go and pitch the company? As you're doing the meetings, give feedback on how the deck is going. What is the market saying? What are others saying? And so it's kind of a virtuous cycle, if you will, of choosing the right investors, right partners, working with them, and it helps with future fundraising as well. I know that you guys were super helpful this time around.
Note, we have one slide in our Series B deck that I baptized the JR. because basically every time
I know which
share
one you're talking about.
I share the slide that part, the slide deck with Jeff. We'll come back to that slide and say this and this and that. I'll incorporate it, and you're totally right. And I will get pissed with myself because he had a better idea than I do, right? Jeff, I'll do it, and we kept iterating on that one. And
I need to frame that slide and put it on my wall.
It's a winning side. It's actually a winning side. So it's gonna be the JR forever.
Hey guys, so we got a few minutes left. Can you guys talk about sort of where does Belong go from here? What's your vision for the company, and what are you guys focused on over the next 12 months as you try to scale this business? And what we talked about is a it's a hard industry. It's hard to build any company, but you're building in a particularly hard industry. What are you thinking about, and what are you focused on, and where do you dare to dream? Where is the company in 5 to 10 years?
Right. So what we have today, we consider no more than a proof of concept. It's more than that. We have real revenue, and we have very good growth and good unit economics. We like to think that we have a good product that our community members love. But it's very early days, right? And that's what I say to the team, and what O repeats to the team all the time, and what I repeat to O and O repeats to me. We just raised an amazing Series B. We have a set of investors. We have money in the bank. Now we have even higher expectations of what needs to be delivered, right? So let's call that the proof of concept, a product that the early community members, the early homeowners and residents are loving, right, and using, right? And how do we expand that in a way that is thoughtful, and at the same time that captures the market opportunity? And that can go into the rabbit hole of that, which is, I personally believe that there's almost a moral imperative to go as fast as possible. When you're a founder and you have a market opportunity like Belong has, right? It's a moral imperative for the world because we think that we're doing something that's good for the world. It's a moral imperative for my family, right? Because I want to provide them with the best possible opportunities and give them the example of what it means to build, right, for the world. It's more imperative for your team members, right? Because each of them are betting their careers on us, on this idea of Belong. And the market opportunity may not be there forever, right? Market opportunities are very flaky in the sense that something changes in the macro environment, something like we had coronavirus for 12 months already, and it could be gone, right? So we need to go as fast as possible. And the way that we think about going as fast as possible is counterintuitive, right? It's quite slowly being able to choose and train and work with the best people in the world, right? So that's what we're focusing on. Mm-hmm. Immediately after the Series B, I did two things. I almost cleaned my calendar from operated meetings, right? And left only the most important ones to let my team, our team, execute without me being too looking over their shoulders. And we went to start the process of finding those key people that are going to join the team and are going to Belong for the future. So I see particularly myself as, here's what I think this market should look like. Here's what I think it could be. And this is the team that is going to get us there. It's not going to be me. It's not going to be right? The ones that are going to get us there. So that's what we're focusing on. That's who are the best people in the world to go and execute against this market opportunity as fast as possible so that we can fulfill a promise to everyone we love. That's the idea.
I love that. I spoke with the CEO of a $70 billion company yesterday, and he said the same thing. He said, I feel like we have a moral imperative to go take advantage of the market opportunity that's in front of us. And he said, I wake up every day afraid that we're not pushing hard enough. He said, it's hard to live between these ears because I wake up every day fearful that we're going to blow the opportunity, but it creates that sense of urgency, which I think is awesome. And it's why you guys are so special at what you do. Well, hey guys, this has been awesome. Thanks for taking the time. Ale, Roger, this has been awesome. Really appreciate it. It's been fun.
Thanks, Jeff. Appreciate you asking us to join.
Thank you, Jeff. Thank
All
you,
right, guys.
Roger.
Take care.
Thank you, Alex.
Thank you. Oh, thank you, Jeff. Thank you, Roger. Thank you, Lisa, for organizing. It's been wonderful.
Bye-bye.
Bye, guys.